Hello, everyone. Welcome back to our channel of Asian Exporters Chamber of Commerce and Industry. I trust this video finds you well and thriving in your global trade pursuits. In our previous sessions, we have delved into the intricacies of international trade, exploring subjects ranging from trade finance to government policies. Today, we embark on a crucial discussion that holds immense significance in the world of global commerce, that is, credit risk and insurance for global trade. So, as we navigate through this session, we aim to unravel the complexities and nuances surrounding credit risk management and the pivotal role insurances plays in securing seamless international transactions. So, credit risk, a factor inherent in every business deal, can significantly impact the success of global trade ventures. Understanding how to assess, mitigate, and manage this risk is paramount for businesses aiming to thrive in the international market. So, moreover, we will shine a spotlight on the crucial role of trade credit insurance. And this invaluable tool provides a safety net against unforeseen circumstances, offering businesses protection and confidence as they engage in cross border transactions. So, everyone, my name is Tahreem Mullah, and I am your host for today's session and the Executive Director of the Asian Exporters Chamber of Commerce and Industry. It's a privilege to guide you through the enlightening exploration. And with my background in international trade and extensive experience working closely with our esteemed members, I am enthusiastic about sharing insights that can empower your businesses in navigating the intricacies of global trade. So, as we delve into the world of credit risk and insurance for global trade, let's keep in mind that AECCI stands as your unwavering ally. We are committed to being your go to source for knowledge, support, and the continued enhancement of your trade endeavors in the dynamic landscape of international trade. So, thank you for joining us today, and let's begin on the insightful journey together. So, as we start on this session, let's keep in mind that ACCI is your STECPART support system, and we are your go to source for knowledge, assistance, and the enhancement of your business endeavors. Okay, so having started that preliminary insight into our session, I am excited to steer you through the forthcoming presentation, thoughtfully prepared by my digital efforts team. Our focus today is on credit risk and insurance for global trade, a topic integral to navigating the complexities of international commerce. So, together, we will explore the foundational aspects that form the cornerstone for success in global trade. Throughout this presentation, my primary goal is to provide you with a comprehensive understanding of the critical elements associated with managing credit risk and utilizing insurance strategies to safeguard your international transactions. So, together, we will gain insights that can empower you to make informed decisions and navigate the intricate terrain of credit risk and insurance for global trade with enhanced clarity and confidence. So, let us get started. Okay. So I'm honored to be here today as representative of AECCI, an organization committed to facilitating smoother international trade experiences, particularly for Asian businesses entering this dynamic arena. Our core mission revolves around empowering exporters, providing essential resources, fostering valuable network opportunities, and offering personalized support system to give them a competitive edge in the global market. So ACCI draws strength from our expansive member network and strategic partnerships. Together, we cultivate a vibrant environment that supports robust export activities. Your presence today is genuinely appreciated as we embark on this collaborative journey. And in the first paced and in this fast paced landscape of global businesses, access to timely and accurate information is paramount. So, ACCI is dedicated to delivering comprehensive, tailor made insights that cater to your specific business needs. Whether you have pressing questions or require reliable resources, rest assured that ACCI is fully committed to fortifying your business endeavors. Now, let's delve into the heart of our presentation, meticulously crafted by my team. Together, we will explore the fundamental elements that contribute to the success of international trade. And my role here is to be your guide, aiding you in gaining a better understanding and the confidence to navigate the intricate world of international finance. So, whether you are a seasoned professional or just embarking on your journey in international trade, I firmly believe there's always something new to discover and leverage for your benefit. So, let's seize this opportunity to learn and grow. Okay, so starting with what is trade credit insurance? Before we dive into the details of credit risk and insurance for global trade, let's take a moment to understand what trade credit insurance is. So, trade credit insurance is a specific type of insurance designed for companies engaged in trading, and its purpose is to shield these companies from the risk associated with non payment. This insurance serves as a risk management tool, offering protection against potential losses from unpaid goods, invoices, and other debts. It's commonly referred to as credit insurance and is distinct from other types of credit products. So, credit insurance plays a significant role in international trade, especially in larger transactions where risks are more prevalent. The broader category that encompasses the financing of both domestic and international trade is known as trade finance. And trade credit insurance falls under this umbrella as it is particularly useful for exporters in managing and reducing the risk of credit loss. It also provides protection against non payment for various goods and services, although it's frequently utilized to safeguard foreign or export account receivable. It can also be applied in domestic scenarios. It is important to note that trade credit insurance is not available for individual customers. Next, we have how can credit insurance work with trade finance? Let's break it down. Imagine your profit margins are 5% and a customer can't pay you back a 2 lakh dollar debt. To recover from this loss, you would need to make 40 lakh dollars in sales. That's a tough spot for any company. This is where trade credit insurance steps in to help. It works to reduce these losses, allowing the company to keep running smoothly. The key is not just getting the losses covered by partnering with an efficient provider who can do it quickly, but also having access to funds is crucial for a company to operate without any hiccups. Now, especially in big international trades, trade credit insurance becomes super important. Companies can face financial troubles for various reasons, and they might not publicly announce it. That is why having an insurance policy with a company that keeps an eye on their credit worthiness is almost a must. Next, we have is how to secure trade credit insurance. Getting credit insurance starts with reaching out to trade credit insurance broker or provider. They will ask for some details about your company, the trade you are involved in, and information about your customer, like the one who owes you money. Once you have given them all the needed information, they will give you a code for the insurance policy. Once you make the payment, the policy becomes active. And this paperwork for credit insurance can be a bit detailed, and you will have to provide accounting figures along with other necessary information. And you can find and contact many trade insurance providers easily online. Now we have understanding limitations of trade credit insurance policies. Trade credit insurance has a few drawbacks beyond just the upfront cost of buying a policy. One downside is that there is usually limitations on when and how you can make a claim, like having a maximum limit on claims. If the debtor disputes the balances, the credit insurance providers won't pay out on the policy, and this kind of disagreement happens quite often. Companies buying the policy often need to submit regular reports, adding to the administrative workload. And moreover, these policies can often come with annual deductibles, meaning it's not a straightforward dollar first solution. Now, what is guarantee? A guarantee is like a financial safety net that banks provide to the businesses in different situations. In trade finance, guarantees serve three main purposes. Firstly, there's something called an advance payment guarantee. Like imagine a business is buying things from another country and pays a part upfront. The guarantee makes sure that if the seller can't fulfill the deal, the buyer gets their money back. It's like a security deposit provided by a third party, often a bank. Secondly, there's a performance guarantee. This one protects the buyer if the seller doesn't fully meet the terms of the deal due to the mistakes, delays, or lower quality. So the banks steps in to cover any financial losses of the buyer. Lastly, in some places, banks can't directly give guarantees. So they use other methods like standby letter of credit, SLCs, to make sure businesses are financially protected in their deals. Guarantees versus insurance. Guarantees and insurance might seem similar, but there are three main differences that set them apart. First is agreement structure. Guarantees work through an agreement between one of the parties in a deal, like a buyer, and the third party, usually a bank. This agreement is separate from the main deal between the buyer and the seller. On the other hand, insurance is a direct deal between the insurance company and the person buying the insurance. Like, for example, before your supplier starts working on your order, they may ask for an upfront payment to secure the deal. You, as the buyer, you don't risk losing the money if something goes wrong. So, you ask your bank for an advance payment guarantee. This guarantee ensures that if the supplier can't fulfill the order, you get your upfront payment back. Next, we have is focus of coverage. Guarantees are all about making sure the parties stick to their deals or handle any hiccups smoothly. It's specifically about the performance within contracts. In contrast, insurance covers the entire deal and protects against potential losses. Like, for example, now let's say your supplier needs some time to manufacture the goods, and there's a chance they might face delays. To protect yourself, you request a performance guarantee from the bank, and this guarantee promises that if the supplier doesn't deliver on time or meets the agreed quality, the bank will cover any financial losses you might incur. Next, we have is cancellation and expiry. Insurances can usually be cancelled by either the insurance company or the person buying it, as long as they give enough notice. Guarantee, however, can't be cancelled. They naturally end when the deal they apply is completed. Like, for example, finally, when the goods are ready and it's time for the final payment, you may use a completion guarantee. This guarantees that the supplier will deliver exactly what you ordered, and if they don't, the bank steps in to make things right. Payments are exchanged, the contract is fulfilled, and the guarantee expires. In this way, guarantees act as a safety net, ensuring that even if things don't go as planned, your financial interests are protected throughout the entire business deal. Next, we have is bond in trade. Trade bonds are like safety net widely used in global businesses. They play a crucial role in reducing the risk involved in international trade, especially for exporters dealing with partners in other countries. So, here is how it works: exporters assurance. Imagine you are an exporter and you want to make sure your business is protected when dealing with a buyer from another country. To ensure everything goes smoothly, a financial helper issues a bond on your behalf. Next, we have is transaction security. This bond acts as a guarantee for the deal outlined in your export contract. It's like a promise to your buyer or their bank that you will deliver as per the contract terms. If for any reason you can't meet those terms, the buyer can call the bond. Third is compensation safety. If the contract isn't fulfilled as agreed, the buyer can use the bond to get the compensation. It's a way of making sure everyone sticks to the deal, and if something goes wrong, there's a financial backup in place. Next, we have is bond products in trade. Bonds used in different scenarios act like safeguards in various commercial situations to ensure that both parties in a deal stick to their agreement. First is bid bonds. Imagine you are an importer looking for someone to take on a contract. Bid bonds assure you that if the bidder wins the contract, they will actually go through with it. This bond is typically a small percentage of the contract value and serves to compensate you if the bidder backs out. Second is performance bonds. To make sure the products you are buying meet the agreed quality, performance bonds come into play. They impose penalties if the exporter doesn't deliver the right quantity or quality. While they provide financial assurances, they don't guarantee that the bank will step in to fulfill the contract. Third, we have is advance payment bonds. Sometimes importers needs to pay exporters in advance. An advance payment bond assures that if the product isn't delivered as promised, the exporter will refund the advance payment. The bond's value is agreed upon in advance and paid immediately if needed. The fourth is warranty or maintenance bonds. After a transaction, if an importer wants to delay full payment for a while, warranty or maintenance bonds can be used. They guarantee that the exporter will uphold promises such as providing a warranty period or servicing the goods for an agreed time after the sale. Now let's walk through the example of how different types of bonds can be used in a trade scenario. So, first is bid bonds. Like here, the situation I have given you is that an importer is looking for a contractor to build a warehouse, and multiple construction companies bid for the project. So, here is how bid bond works. Each bidding company provides a bid bond, assuring the importer that if they win the contract, they will carry it out. The bond is usually a small percentage of the project cost. Second is performance bonds. The situation here says that the construction company wins the contract but fails to meet quality standards or complete the project on time. So here is how the performance bond work. Like the importer can use the performance bond to impose penalties on the construction company for not fulfilling the contract terms, ensuring compensation for any losses. Third is advance payment bonds. Situation is the importer decides to pay a portion of the project cost upfront to help the construction company start the work. Now, here is how the advance payment bonds work. To secure the advance payment, an advance payment bond is issued, assuring the importer that if the construction company doesn't deliver, the advance payment will be refunded. Next is Next situation for warranty or maintenance bond is the construction company completes the project and the importer wants assurance that the construction work is durable. Here is how it will work. Like the construction company provides a warranty or maintenance bond, guaranteeing that they will address any issue during a specific period, ensuring that the importer's peace of mind. In this matter, bonds act like a money safety net, making sure both sides in a trade deal do what they promised and offering compensations or reassurances if things don't go as expected. Now, what is surety? A surety bond is like a safety agreement involving three parties. Here's how it works. First is oblige, second is principal, and then comes surety. Oblige. This is the first party, often someone who's unsure if the other party in a deal will stick to the agreement. In international trade, it is typically an importer dealing with a foreign supplier. Principal. The second party is the supplier, the one obligated to fulfill the terms of the deal. Dealing with foreign suppliers can be risky due to the legal complexities, like insolvency issues in the country. The next is the third party. The third party is the surety, providing a surety bond to ease the risk. If the principal fails to meet the deal terms, the oblige can claim against the bond to recover losses. The surety pays up covering the losses and then collects the amount from the principal. It's a way to ensure that deal goes smoothly, even if unexpected issues arises. Okay, here are some of the examples of how surety works. First is construction project. Suppose the given situation is an oblige, like the project owner hires a construction company, the principal, for a building project. To ensure the project's completion, the oblige requires a surety bond. So, as per the surety bond in action, if the construction company fails to fulfill the contract by not completing the project as agreed, the oblige can claim against the surety bond. The surety then compensates the oblige for the losses incurred. Second is international trade transactions. Here's the situation. An importer, the oblige in the US, is dealing with a foreign supplier, the principal. Due to the risk associated with international trade, the oblige requests a surety bond from the supplier. Surety bond in action is like if the foreign supplier fails to deliver the goods as per the contract, the importer can claim against the surety bond. The surety pays the importer, covering the losses, and later collects that amount from the supplier. Next is service contract. Situation here is that if a company, an oblige, enters into a service contract with another company, the principal, to ensure the service are provided as agreed, the oblige requires a surety bond. And surety bond in action is like if the service provider fails to meet the contract terms, the oblige can claim against the surety bond. The surety steps in to compensate the oblige for any financial losses. In these examples, the surety bond acts as a safeguard, ensuring that if the principal fails to meet its obligations, the oblige is protected financially and the surety steps in to make things right. Now is surety versus guarantee versus insurance. Let's break it down into simpler terms. Let's break it down into simpler terms. Okay, surety. Think of a surety like a special kind of guarantee. It's a financial product that steps in if a contract gets broken, especially if there is an immediate termination due to issues like insolvency, financial trouble. Then is guarantee. Guarantees come in various forms and deals with different risk in contracts. They can help when things go wrong, like if someone doesn't deliver on time or fulfill a contract they agreed upon. Difference from how it is different from insurance. With surety, if the third party has to pay for a contract breach, they can get the money back from the one who broke the contract. So the person who was supposed to do the job is still responsible for paying. In contrast, insurance pays a fixed amount if there's a successful claim with no extra financial responsibility. The fees for surety bonds cover the services provided, mainly the financial backing they offer. On the other hand, insurance premiums contribute to the overall cost of the insurer, reimbursing those who make successful claims. Claim management. Now let's simplify the idea of claim management. Advisory service. Claim managers give advices to people who have a financial product like insurance about their claims. They help policyholders get the full money they should get. They also check claims in detail, giving their fair evidence about what happened. Like, for example, given a scenario, you have an insurance policy and your house gets damaged in a storm. Claim managers advise you on what documents you need, represent you to get the full amount of repairs, and investigate the details to provide evidence. Next is operational help. Claim managers make things easier for you when dealing with claims. They handle the paperwork, provide clear info, and speed up the process. And this reduces the work you have to do when making a financial claim. Like, for example, given a scenario, for you file a claim for a damaged car under your auto insurance, claim managers take care of all the paperwork, guide you through the process, and make sure everything is processed smoothly. Claim assistance. If there's a problem with a contract or financial product, claim managers figure out who's responsible and how much money should be paid. Like for simple cases, it might just mean giving money. But for complicated cases, like with certain types of bonds, claim managers investigate why the contract was broken and who is to blame. They also try to get back. They also try to get back the money they paid from the party that caused the problem. Like for example, your business has a performance bond and the contractor fails to meet the terms of the contract. Claim managers investigate why this happened, figure out the responsible party, and help you get the compensation you are entitled for. Next is fraud prevention. Claim management can also be about checking if something wrong happened with financial products. They investigate claims to quickly find out if there's any fraud, like dishonest behavior, to protect honest customers. Say, for example, your company uses a trade finance product and there's a suspicion of fraudulent activity. Claim managers quickly investigate the claim to determine if there's any dishonest behavior, preventing potential fraud and protecting the legitimate customers. Like, here are some of the advices on claims and choosing a partner. When you need to claim, you can take your time. The advice here is breach of contract is serious. Take time to understand the implications, informing all involved parties about the situation. Information is key. Investigate and understand the terms of the financial product, payments, terms, fees, and the claiming procedures. Clarify your position. Discuss potential claims with the trade financier. Understand the process, the team involved, and the guarantees for resolutions. Choosing a partner. So here's the advice that explore various firms offering claim management services. Your choice impacts service quality and claim outcomes. Know your rights. Understand industry regulations. Representatives must be qualified individuals from reputable institutions. Follow the money. Be aware of claim management fees. Clarify any significant fees, especially if opting out or changing claim managers. When agreeing to terms, consider your settlement. How your claim is managed affects your settlement form. Understand how it will be paid. Confirm your rights. Here's the advice. Check if claim managers restrict engagement with other parties. Confirm your freedom to choose agents, firms, or contractors. Give yourself flexibility. Ensure you have a legal right to cancel a claim management contract within a fixed window, typically 14 days. include this in negotiations. So, here now, how AECCI support for credit risk and insurance in global trade. As a dedicated organization committed to enhancing the global trade experiences for Asian businesses, the Asian Exporters Chamber of Commerce and Industry stands ready to provide invaluable support to its members in navigating the complexities of credit risk and insurance in international commerce. First is tailored resources and insights. AECCI understands the significance of timely and accurate information in the fast paced world of global business. Our commitment involves delivering comprehensive, tailor made insights that cater specifically to the unique needs of our members, whether it's understanding credit risk, exploring insurance options, or staying informed about global trade dynamics. ACCI provides resources that empower members to make informed decisions. Next is networking opportunities. Being part of the ACCI community opens door to invaluable networking opportunities through strategic partnerships and an expansive member network. ACCI creates an environment that supports robust export activities. Members can connect with industry experts, fellow exporters, and the financial institutions to gain insights into best practices for managing credit risk and utilizing insurance strategies. Next is educational initiatives. ACCI is committed to fostering continuous learning and growth. Our educational initiatives, workshops, and seminars provide members, whether seasoned professionals or those new to international trade, with the knowledge and understanding necessary to navigate the intricate terrain of credit risk and insurance for global trade. Next is access to expert guidance. Members can benefit from expert guidance provided by AECCI representatives who are well versed in international trade dynamics. This includes assistance in understanding the nuances of credit risk, selecting appropriate insurance products, and effectively managing financial transactions to safeguard against potential losses. Next is facilitating insurance connections. AECCI can play a pivotal role in connecting its members with reputable trade credit insurance providers. By leveraging its network, AECCI can assist members in securing insurance coverage tailored to their specific trade scenarios, ensuring protection against non payment and other associated risks. Next is advocacy for member interests. AECCI actively advocates for the interest of its members in matters related to trade policies, insurance regulations, and credit risk management. AECCI works to create an enabling ACCI works to create an enabling environment that supports the growth and success of Asian exporters in the global market. Next is collaborative initiatives. AECCI believes in collaborative growth. Through collaborative initiatives with financial institutions and insurance providers, AECCI seeks to negotiate favorable terms and conditions for its members, making credit risk management and insurance more accessible and beneficial. So, in conclusion, the Asian Exporters Chamber of Commerce and Industry is not just a platform for business interactions, it is a dynamic support system empowering its members with the tools, insights, and the connections needed to effectively manage credit risk and insurance in the complex landscape of global trade. So, together, we navigate challenges and seize opportunities for growth and success. So, thank you for joining us on this insightful journey into credit risk, insurance, and global trade. We hope this presentation, thoughtfully prepared by the Digital Efforts team and presented by me, has equipped you with a comprehensive understanding of the critical elements involved in managing credit risk and leveraging insurance strategies for international transactions. So, everyone, as we navigate the intricate terrain of global commerce, remember that knowledge is power. Whether you are a seasoned professional or just beginning your journey in international trade, there's always something new to discover and leverage for your benefits. If you found value in today's discussion, we invite you to share this video with your colleagues and peers. Don't forget to subscribe to our channel to stay updated on future insights, discussions, and expert interviews. Your engagement is crucial, and we appreciate your time and attention. So let's continue learning and growing together. If you have any questions or topics you would like us to cover in future sessions, please feel free to leave a comment below. Thank you once again for watching, and until next time, stay informed, stay empowered, and stay ahead in the world.